The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A resilient job market breathes some life back into equities. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. I had to read that a few times.
Did I see you earlier today on the opening bell?
Yeah, I just really wanted to open and close the markets, and we're getting closer to the close. So let's take a look at where we stand. The S&P 500 really breathing momentum into this rally. You can see the S&P 500 up by about 0.6%. I wanted to throw up small caps on the board, though, because we're paying a lot of attention to big tech today, but the Russell 2000 up by 1.7%. Small caps in the lead right now, and that's even though you do have a little bit of a sell-off when it comes to the bond market, Romaine. You take a look at 10-year Treasury yields higher by about 2 basis points, though we are below 4.5%.
Well, let's go back to stocks because the economic data really moving the needle, particularly on those small caps. We talk about a market that had been somewhat dormant for the past 4 sessions. Government data this morning showing U.S. job openings unexpectedly rising in April, a fairly broad-based advance in that data that indicates demand for workers was actually still healthy amid all of that Liberation Day-induced economic agita. And that brings us to the broad-based advance that we are seeing in this market today, with the small-cap Russell 2000 outperforming the S&P, Katie, by the most in a month. But that trading band, it's still tight, if not cautious. And, of course, that's largely because of the elephant in the room, which, of course, are the elephants in Washington. The White House pledging to move forward with those steel and aluminum tariffs tonight. And that tax cut bill that's working its way through the Senate being blasted by former First Buddy Elon Musk as a budget-busting abomination. David Booth, though, you might know him, Katie, says look past the short-term noise. But if you're a long-term bond investor, you got to be compensated for that din, right? Particularly for a budget bill that could reduce appetite for U.S. assets, which by default, no pun intended, would imply a higher term premium that Citigroup strategists could mean an extra 50 basis points in yield.
Well, let's talk a little bit more about that term premium and get a look at where we stand, because since the mid to late 80s, term premium when it comes to 10-year debt had just been declining and declining, as you can see in this chart. But if you really train your eyes on the lower left-hand side of that, I guess right-hand side for the viewer, but in any case, you can see it's been rising a little bit. We finally exited negative territory just in the past year or so, and now we're looking at the highest term premium, 10-year term premium, since about 2023, Romaine.
Oh my gosh, Katie, you're really going back in time there. Winnie Cisar joined us right now, Global Head of Strategy with Creditsights, to kick us off to the close. That term premium, is that attractive to you right now?
The olden days of 2023. So I think that we're getting a little bit more neutral on long-on Treasury yields. There is definitely a risk that things move higher. There are a lot of factors percolating in the system, in the big, beautiful bill, and what are non-U.S. investors doing with duration. But when we look on a historic basis, thinking about kind of the reality of where yields are, and also the reality of how much is there in the global financial system of high quality, high yield in that duration segment? There's not that much. There's really no other places that investors can go en masse. So while there might be some volatility in the long end, we're getting a little bit more neutral.
Do you feel, though, I mean, when we talk about the long end of the curve, whether we're talking treasuries or even in actual corporate credit here, there's been a lot of talk about a quote-unquote buyer strike, the idea that you just are not necessarily getting that compensation. Are you seeing that on your end, particularly on the corporate side?
Yeah, so what's interesting is within corporates, you do have this dedicated base of people who are just buying, right? You have asset and liability matchers who are getting constant inflows, life insurance companies who need to put cash to work in the long end of the curve. And looking at corporate credit at 6+%, that's historically a pretty good opportunity. At the same time, on the retail side, we're seeing a big shift in appetite to the front end of the curve, which was basically where nobody was buying for the past couple of years as the Fed was hiking rates, and really not a lot of retail demand for intermediates, total return funds, or long duration. So there has been this shift from retail to institutional, a little bit of a buyer strike, but not necessarily one that has had all that much impact on spreads.
That's really interesting to talk about the shifting appetite for short-dated debt, because going to the absolute extreme end of the short end of the curve, you think about money market funds have been so popular for so long. I believe we still have about $7 trillion in money market funds, and it has to be so frustrating for active managers. It's so hard to get people to feel comfortable moving out of cash.
It's so true. And we've seen in the April volatility and into May, money market fund inflows are still really, really high. And that has been true in the U.S. It's been true outside of the U.S. And I think this comes to policy rates, right? Nobody is going to say cash doesn't look attractive until cash is yielding something meaningfully lower than current levels.
Yeah, it's interesting. And it seems like that gets farther and farther off as we push out Fed rate cuts. I think there's still 2 to 3 priced in for this year right now, though. Does that look right to you, Winnie?
So I think that the market is actually pricing in kind of an aggregation of 2 distinct outcomes. First is the stagflation outcome, where the Fed just has to sit on hold or even message slightly higher policy rates because inflation is coming back. Or at the other end of the spectrum, the labor market really starts to unwind. The Fed is grappling with a recession, and all of a sudden they're cutting 100 basis points quite quickly. And I think that's how the market implied 50 basis points of easing gets priced in. Because when I think about the conditions that would set up for immaculate disinflation that lets the Fed just kind of proactively and gradually ease, feels like maybe that is off the table at this point.
What are your thoughts right now in the high yield space?
High yield is tricky. I love high yield. I'm a left-fin person, historically. But, right now spreads are so tight, and the distribution of valuations, there's not a lot in the 7.5% area. If you look at high yield and you see 7.5% yield, historically, that's a buy. It's a really great forward indicator of total returns. But when you're trying to put together a high yield portfolio, there's a lot clustered in that 6% range, and then there's a lot clustered in 10, 11, 12, 20%. And so to get to that 7.5%, you have to have some high conviction on some of those stressed or more distressed names. Yeah. And that's hard to get to right now.
In this environment, how much of that process is truly bottom up, and how much of that has to be kind of from the top down, meaning more of a focus on the macro and the budgets and Washington and all that stuff?
So, I think that the macro and the budgets, it really matters, right? All of those things flow into bottoms-up decision-making. And right now, a lot of companies are a little bit paralyzed, especially smaller companies who are trying to figure out, is there an M&A opportunity? What's my cost of capital going to be? How am I going to manage working capital? All of these other things that, so for some of the bigger issuers, for the investment grade world, are a little bit easier to manage through because they just have more flex in their balance sheet and capital structure.
If we expand the universe a little bit, something that I frequently instant Bloomberg you about is what's going on in CLO land. I look at it through the lens of ETFs. JAAA is the most popular one, but it's interesting. For so long, it was just one-way flow into JAAA, people buying up into top-rated CLO securities. It seems like that has really cooled, and now you actually see two-way direction, which we've never seen in this particular fund. Where do things stand currently?
Yeah, CLOs are interesting. Things have cooled off a bit for sure. When you think about what a CLO is, it's a levered play on credit. And if you are concerned about the Fed having to aggressively ease rates, then there goes your kind of base rate and floating rate alignment. And if you're concerned about a default cycle or a downgrade cycle, there goes your constructive view on credit. And so seeing this shift a little bit away from the world of CLOs makes some sense to us, just given all of the complicating factors. And then when we look at where CLO valuations are, they're still not particularly cheap. And so having that two-way flow does make some sense to me.
All right, Winnie, always appreciate it. Winnie Cisar, Global Head of Strategy with Creditsights, kicking us off to the close here on this, what day is it today, Katie? It's a Wednesday afternoon.
There you go.
We do have some breaking news. This is involving
Tuesday,
BlackRock. Thank you, Katie Greifeld. I've lost track. Katie Greifeld here specifically for that, but we're also here, of course, for the breaking news. BlackRock, we've learned, has been removed from the blacklist in the state of Texas. Remember, there was basically this 3-year-long standoff between BlackRock and Texas over the company's ESG policies. Apparently, I don't know, that's apparently been resolved. Danielle Moran joining us right now to talk a little bit more about this. What do we know, Danielle?
Well, today, BlackRock has been removed from Texas's blacklist of companies that they deem to boycott the fossil fuel industry. So this all stems back to a 2021 law that was passed in the state that made Texas review all of these financial firms and their ESG policies. So what came out of it was there was a list that was put in place, and that had certain investment restrictions for state entities like pension funds or the Permanent School Fund in Texas. And BlackRock was on the list. It was put on the list in, I think it was August of 2022, and it's remained on there until today when Texas took it off.
So you have to imagine that BlackRock CEO Larry Fink is feeling pretty good right now because he's really been on a charm offensive in the state.
Yes, there has been a lot of movement in Texas. They were removed from the list because they rolled back some of the ESG policies that got them there to begin with. So they've pulled out of the Net Zero Asset Managers Initiative. They stepped back from the Climate 100 Plus program. And Larry Fink has made a real effort to engage with Texas officials. He stood on stage with the Lieutenant Governor last year and held a summit about Texas's energy grid. And BlackRock has been making moves in Texas to show its support. And while the controller who maintains this list said that that is unrelated to its listing decision, it shows BlackRock's support for Texas.
I don't buy that. But I am curious just about this idea of sort of whether Texas really had any choice in this matter. When they sort of got into this battle, not only with BlackRock, but with JP Morgan and a few other things, not just on ESG, but on DEI and a few other policies, there was always this idea here, too, that you kind of need these big institutional firms because, well, that's where all of the market activity is. And if you're blocking your pensioners out of this, you're basically blocking them out of return, out of yield that every other state in America is getting.
That's very true. And there's this big back and forth between what they can actually do. And there is carve-outs in this law specifically that said if pensioners were going to be hurt by this, Texas entities wouldn't have to divest. But this is also a real win for BlackRock because they've been in this sort of back and forth with Texas. And this allows them to say, we're good, they cleared us. And now that the Texas entities can invest with them without restrictions.
Yeah.
All right, Danielle, great reporting as always. That is Danielle Moran breaking the news that BlackRock has escaped the Texas oil boycott backlash after its ESG retreat. We'll continue to follow that story, but let's turn to trade now, one of the other big stories of the day, and the U.S. putting trade partners on notice, sending a letter with a, quote, friendly reminder about an upcoming tariff deadline, according to the White House. Now, this comes as trade talks fast approach and countries are on edge ahead of the July 9th date when higher tariffs are set to take effect. Joining us now to discuss is Rohit Chopra. He is former CFPB director and former FTC commissioner. Great to have you with us. We've been very focused on the relationship between the U.S. and China and whether or not we're going to get a phone call between those two countries' leaders. But it's a good reminder, this friendly letter, that we're negotiating with the whole world, it feels like.
Well, I'm not really sure they needed a letter to know about all of the global calamity that could occur for the economy if none of this trade disruption stops. And I think already we're starting to see retailers and others know that they can push up prices and pin the blame on tariffs, even if some of those tariffs don't take effect.
Well, to your point, we heard from the CEO of Dollar General today saying that they're probably going to have to look at price increases in the future due to tariffs. It sounds like you're saying we're probably going to see more of that and probably across the spectrum here.
Well, here was one of the lessons from the pandemic is that the supply chain disruptions led to price increases, not just on those goods that were affected by it, but all of them. And many retailers were openly boasting that they could use this as a way to magnify margins. There's already some reporting to suggest that Walmart and other big retailers have already started to up the prices with triple-digit percentage increases, even though they may not even be covered by tariffs.
Right. Well, that is anecdotal. And Rohit, I mean, we should know. I mean, this shouldn't come as a surprise. I mean, we know how corporate America works. The question, though, is where's the oversight with regards to the government? I mean, they have a role in this as well to be able to set the guardrails. And I know President Trump has been at least vocal on social media about saying don't, raise prices or else. But, that's just a threat on social media. Where's the guardrails in terms of the real world and our government in Washington?
Well, I mean, we're already seeing how so many of the key agencies, including the agency I ran, the CFPB, are fundamentally getting dismantled. Those are the agencies that are enforcing some of these key laws that really stop people from getting exploited or abused. So I'm really worried that big companies will exploit this and that all of the core issues people are facing when it comes to the costs of groceries and everyday goods, that they will not see any relief. Yeah,
and I get that. And I don't want to sound like an apologist for the corporations. But again, you have to put this back in the lap of Washington, a place that you are in right now, a place that you worked in for years. And at the end of the day, these are policies that are driving the changes in corporate America?
Well, I think if we had a policy architecture that was focused actually on reshoring goods, we wouldn't just use tariffs willy-nilly against random countries. We would actually make sure that key goods and that are essential for our national security, that there are some real investments. I think that was some of the work that was done to make more chips in America. But I'm not sure the chaos of negotiating dozens and dozens of deals. We only have a few weeks left, and I'm not sure small businesses and consumers are going to win in this.
I want to switch gears here and also talk about the tax bill. In the last few hours, we heard from former First Buddy, as Romaine said, Elon Musk, also on social media, really criticizing that tax bill that has passed the House. He called it a budget-busting abomination, so not mincing words here. And I'm curious, from where you're sitting, as you watch this bill try to travel through Congress, do you think that senators largely agree with Elon Musk here?
I'm not sure. I think that many of them are in fear of Donald Trump, but when they actually look at the fine print of some of this deal, they are not liking what they see. You're also seeing scores of business leaders and people on Wall Street getting really worried about the massive debt that may have to be financed ultimately from foreign countries, including China. So we'll see how the sausage gets made. But we know that it is going to lead to real consequences for people when it comes to their medical bills, for people when it comes to their interest rates on their mortgages. And a lot of the smart analysis suggests this is going to push up long-term interest rates in ways that could really hurt the economy.
All right, Rohit, always appreciate you taking time for us. Rohit Chopra is the former CFPB director, also a former FTC commissioner, of course, as everyone on Wall Street continues to have their eyes, Katie, on what's going on in Washington. Remember, just a little while ago, we heard from Caroline Leavitt, the White House spokesperson, basically saying that those steel and aluminum tariffs will go into effect on June 4th, as Trump had promised. We're still waiting to see what the outcome of the Senate tax bill is going to be as well. But at least for today, equity markets are taking it in stride, one of the strongest days we've had in a couple of weeks.
Yeah, it's funny. Leavitt kind of brushed aside Elon Musk's criticism, and it looks like the market is brushing aside any fear that it might have over what's coming tomorrow and what might come from the tax bill. Because the S&P 500, I mean, we're off our session highs, but still looking at a gain of about 0.6%. Volume is pretty much average versus last 20 days. So not a lot of fear right now. 59.81
on the S&P 500. That was a high, intraday high of the day. A lot of people want to see the S&P get back to that 6,000 level as a key psychological barrier. We should point out the VIX is subdued on this day, back below 18. You're seeing yields across the curve down about a basis point or two. And look at that. Dollar strength, Katie Greifeld.
Look at that.
The dollar's back.
The dollar's back. So is Dollar General. And I think we're talking about that next. Dollar
General, that's right. Those shares having a pretty nice day as well after its first quarter earnings topped estimates. We're going to get a deeper dive into, well, a big retailer. That's coming up next here on The Close on Bloomberg. All right, let's get a read from the sell side with our top calls. Big movers on the back of analyst recommendations. And we're going to start off today with Pinterest. JP Morgan lifting its recommendation to overweight from neutral. The price target bumped to 40 from 35. Diversifying ad platform capabilities and solid user growth. Two of the reasons behind the upgrade. The shares up 4%, up for a third straight day. Advanced Auto Parts, that's up next. Redburn revving up their rating to neutral from sell. The price target to 45 from 28. Concerns persist around the retailer's investment plan and balance sheet, but Redburn says the company will benefit from a favorable backdrop for the second half of the year. Those shares up for a second straight day. And finally, Lululemon. Evercore maintaining an outperform, but boosting the price target to $400 from $320. The analyst says new innovation around products and clothing will help to drive positive U.S. same-store sales over the next few quarters. Lulu, remember, is set to report earnings on Thursday. Those shares up about 4% on the day, and those are some of our top calls. Another big mover in the retail space is Dollar General, a phenomenal day, up about 16% here after the discount chain raised its annual guidance, beat first quarter expectations, and said, guess what? Those tariffs, we're taking measures to mitigate that. Joining us right now to discuss is Anthony Chukumba, Senior Research Analyst over at Loop Capital Markets. He's got a hold on the stock. All right, Anthony, let's first start with the quarter that was. What did you make of the numbers? Definitely way better than expected than what we saw, at least based on the consensus estimates.
Absolutely. And it was funny because on the one hand, the top line beat, it was a nice beat, but it wasn't that huge of a beat. It was really the profitability that was much better than expected, including a significant improvement year over year in gross margin. A lot of that was due to lower inventory shrink. And so you had a very, very substantial earnings beat. And then the company did raise their guidance for fiscal 2025. So all in all, it really was a very, very good quarter for Dollar General.
I am curious about the guidance raise. First of all, how much confidence do you have in them that they'll meet that guidance? And also, in an era where I think every company right now, particularly retail companies and companies with outsized exposure to what's going on with trade and tariffs, why do you think they had the confidence to actually bump up that guidance?
I think a lot of it had to do with the fact that they are seeing this trade down. They are seeing more middle and higher income customers coming into their stores because of macroeconomic uncertainty. They said that this was the highest level of trade down activity that they had seen in 4 years. The second thing is, yes, they do have plans in place to mitigate the tariffs, but they have a lot less exposure, I think, relative to a lot of other retailers. First off, because 75 to 80% of what they sell is consumable. So think food items, health and beauty care items, cleaning supplies, right? So these are not nice to haves, they're must haves. And then also their, overall China exposure, particularly relative to a lot of other retailers, is quite low. So I think that that's what gave them the confidence to increase their guidance.
So this is all good news for Dollar General. Of course, you just look at the shares and you can see that having their best day in about 3 years. But if I wanted to get worried about the broader economy, it sounds like I can do that looking at these results based on what you're saying. The fact that you are seeing this trade down, that you are hearing the CEO of Dollar General say, we're seeing higher income consumers come to our stores.
I think there's a lot of truth to that. A lot of it just really comes down to uncertainty, right? One day the tariffs are going to be X, the next day the tariffs are going to be Y. Consumers just want to have more clarity, and they don't feel like they have that right now. They're worried about inflation. They're worried about their jobs. And so, they're looking to save a buck. And so, yes, this absolutely positively does say something about the broader macroeconomic backdrop that you are seeing Dollar General benefit from these higher income consumers trading down to their stores.
And it's funny, of course, we're seeing Dollar General have a banner day, but you can say the same about Dollar Tree, up 6% as well. We're awaiting those earnings. We also get Five Below this week. What can we extrapolate from Dollar General and map over to the likes of Dollar Tree, to the likes of Five Below?
Yeah, I would be a little bit, what's the word I'm looking for? I would be a little bit careful about direct read-throughs, right? Particularly for Dollar Tree, because remember, they're in the process of selling the business that's very similar to Dollar General, right? They're selling Family Dollar. So the remaining business, it's much more tied to discretionary merchandise. There's a lot more exposure to China. So I would be wary. Now, Five Below, they already pre-announced results, and it's unclear what's going on there. You have a management change there. They're trying to kind of refocus their business on, lower priced items and whole dollar price points. So yeah, I would be very, very wary about reading too much into these results for a Dollar Tree, for a Five Below.
Well, there is a broader question, though, Anthony. I am curious, and I just want to get your thoughts. And this really goes beyond just the companies you're talking about. It's just generally about how you view economic conditions going forward through the lens of consumer spending. And I know there was a lot of gloom and doom, even just, a few weeks ago, partly because of the tariffs. That seems, at least in the market, to have dissipated just a tad. And I'm wondering if you are feeling more optimistic about the conditions of the economy and, more importantly, how these companies are going to perform over the next few quarters.
That's a great question. I would say on the margin, I probably am feeling a little bit more optimistic, particularly relative to the way I was feeling in early April. A lot of that has to do with Taco, right? Trump always chickens out. He comes up with Liberation Day and we're going to put all these tariffs on everyone across the board.
Right.
And then the market pukes and then suddenly he's backing off of that, right? And so it just makes me feel like, ultimately at the end of the day,
Right.
we're just not going to end up in this very draconian place. And that's
Right.
probably good for the economy.
Anthony, gotta leave it there. Great to get some time with you. That is Anthony Chukumba. He is senior research analyst over at Loop Capital. This is Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Katie Greifeld.
Can you name all the buildings that were in that picture?
No, not even close.
It's a beautiful day here in New York City.
It is. I'm excited to go outside, but not until 5 o'clock because we have a lot of show to get through and the market closed. And it looks like we're shaping up pretty well.
Yeah, I mean, stocks staging a pretty decent rally. I think partly on the back of those jobs numbers, the job opening numbers, we should say, kind of the prelude to the big jobs numbers that we get on Friday. But early this morning, I don't know what you were doing at 3 a.m. this morning.
Just hanging out.
But the OECD, which is based overseas, which is why they released this at 3 a.m. New York time,
I believe, yes.
Paris time, thank you, came out with interesting revisions in their global growth forecast, specifically because of their concerns about U.S. tariffs.
Absolutely, global and U.S. growth. So they now forecast global economic growth to slow to 2.9% this year. Their previous forecast had been for 3.3%. So you can, or rather, that was in 2024, 3.3%. So a slowdown there. Similar story, but a little bit worse if you take a look at their projections for the U.S. specifically, seeing that growth will slow to 1.6% from 2.8%. So 1.6, still pretty good, but that step down, very dramatic.
And this is the sort of the parlor game that's going on right now because everybody's trying to assess the impact of something that, let's be real, I mean, a lot of what Trump has talked about isn't actually in effect. We know some of those tariffs are here, some of them aren't. And of course, we have no idea whether the full force of those tariffs will ever actually see the light of day.
Yeah, and it's been putting investors and the Fed in a bind, this wait and see mode to see the impact. So let's discuss what could happen, what this all means. We'll do that with Omair Sharif. He is founder and president of Inflation Insights. So like I said, wait and see mode when it comes to the actual impacts of tariffs, how they touch the economy. If you take a look at the headline inflation data that we've got over the past few months that we've gotten, you haven't really seen much of an effect yet. But if you take out your magnifying glass, have you seen any ripple effects?
Yeah, I actually think we have seen some of the effects start to materialize, but they haven't really yet hit the consumer basket yet, more broadly, which is really what I think most people are focused on. We are starting to see it impact domestic manufacturers, though. So just to give you a couple of examples, and this, by the way, will eventually, I think, flow through to the consumer. Think about auto parts, for example. Over the last 3 months, the domestic manufacturers here who make auto parts, they've seen their input costs for domestic products that they purchase go up by about 15% on a 3-month annualized basis. Domestic manufacturers have seen those costs rise on a 3-month annualized basis by about 7.5%. That number was 1% back in January. So costs for manufacturers who make our goods domestically are starting to increase. That is going to take a little bit of time before it flows down the chain. But, as recently as the last CPI, we started to see some things start to pop. So furniture prices, for example, went up almost 2%, which is one of the biggest increases we've seen since COVID. So you are starting to see it bubble up. It's just not as broad-based, I think, as people were expecting. But I think that's on the way over the next, 1 or 2 months, probably.
Well, that's what I was going to ask. What does that daisy chain look like? Okay, manufacturers are feeling it. When does it flow through to the consumer? Your last point there, that we could see it in the next month or so. Do you think that policymakers are viewing the same sort of things? And do you think that consumers are prepared for that potential increase?
Yeah, so I say the next month or two for a couple of reasons. One is that, one of the biggest pieces of what's being affected by tariffs, of course, is autos. And very recently, we saw Ford, for example, which, by the way, I thought was very telling because, of all the big 3 automakers, they produce the most cars assembled in the United States. So you would think, well, they're probably, shielded a little bit. But even they are saying that on some models, they'll begin to raise prices, I think, beginning May 1st for new production. So that should probably start to hit the CPI in June. Subaru just announced price increases at the end of May across all of their models. That should start to hit the CPI in June. So you're starting to see this ripple effect into autos probably materialize in June and into July as well. Policymakers are watching all of this. I think when Walmart said at the end of May, hey, we're going to start raising prices pretty soon here, that I think a lot of people, sort of stood up and took notice because if that company has to start raising prices because they're being impacted by tariffs, then really nobody is going to be spared from the tariff impact. And I think, interestingly, in the FOMC minutes recently, almost all participants said that they were worried about this tariff effect being more persistent than what they had, figured previously. So they're not really looking at this necessarily as a one-off effect yet. They're looking for potentially the domino effect into other prices, into services perhaps, and so on. So I think, everybody's antenna are up right now.
That gets to the question, though, as actually what's driving the price increases themselves. I mean, there's been a lot of anecdotal evidence of price increases, as you said, not to just pick on Walmart, but at Walmart as well as some other retailers, despite the fact that, at least from what we can tell, some of those input costs, those purchasing costs on their end, haven't actually gone up by a commensurate amount. So when you hear the OECD start to revise its forecast down, I do wonder, is it too early for that? And I say that also in light of the fact that Raphael Bostic over at the Atlanta Fed today had an interesting essay where he kind of said the opposite, that he's not ready to make any revisions to his outlook because, as he said, we're just not seeing it yet in the hard data.
Yeah, look, I think it's fair to say, wait and see is kind of the name of the game right now for policymakers as well. So I think it's fair what President Bostic said. He also said that this is not your textbook tariff increase. This is not a tariff increase where we get a price level shift. It flows through one time into the economy, and we kind of reset a year later on the price level. In fact, what he's saying is, look, this has kind of been back and forth. We've seen so many different announcements, raising, lowering, pushing off tariffs to a later date, then pulling them back in. So I could see why he's hesitant, but I will note that the staff at the Fed, if you remember from the minutes, said that they were revising substantially higher their outlook for the unemployment rate for this year and revising substantially higher their outlook for inflation this year. And I think you're going to see in the June SEP some participants probably go down that road as well, where their forecasts are going to adjust. So, I think we know that some of these effects are coming. The magnitude is, I think, what we're all kind of debating. As you mentioned, some of the input costs haven't risen for companies like Walmart, but I think we are starting to see it in the domestic manufacturers. Somebody, by the way, tariff collection has also gone up, right?
Yes,
and so we are seeing more and more companies pay these tariffs. So I think it's just a matter of time before the consumer ultimately, is going to end up paying these prices. So
just to be clear, we get a CPI report next week, I think a week from tomorrow, Wednesday. Today's Tuesday, by the way, Omair. Right. A week from tomorrow, and you're not expecting to really see a meaningful impact on those numbers. But once we get to the June data and beyond, you do think that, that will show up, and more importantly, as you kind of allude to some of the Fed comments, that could potentially be persistent over the course of the next few reports.
Yeah, exactly. So I think May is perhaps still a bit too early. When we started with the reciprocal tariffs in April, my feeling was always kind of June, July was going to be when we really got the impact. Because again, I think when you think about all the imported goods, a huge chunk of that, and just really if you think about the weighting of the stuff in the CPI, 8% of the core CPI is just new cars and used cars. Used car prices started to rise in April pretty sharply. That's likely going to feed into June and July CPI. New car prices, as I mentioned, have begun to rise. So to me, it's June, July. Next week, I think we'll see what we saw in April, which was a handful of items that see really large jumps. So for example, if you happen to be buying audio equipment in April, you saw about a 9% price increase for those items. That kind of, spot increases of various items is likely what we'll see next week, including furniture and some household furnishings. But to me, it's June, July, and don't be shocked if over the summer we've got several months where the annualized increase in the CPI is touching around 5%. So 0.4, 0.5 on the core CPI. I think that's very likely when we get into these summer months.
Okay, well, that's pretty significant. We're at 2.8, 2.9 right around now. All right, Omair. Always wonderful insights. Always learn a lot talking to you. Omair Sharif there is the founder and president of Inflation Insights. And Katie, we do get that CPI report next week, next Wednesday. Core CPI, at least based on the Bloomberg terminal, looking like folks are looking for about 2.9%. So to get up to 5, that's a significant bump higher. I mean, a 1 percentage point move higher is 2 percentage points higher. Sorry.
I'd believe anything
I failed
you told
fifth grade
me.
math, but I rebounded in the 6th grade.
There you go.
But that's a significant amount on consumers' pocket.
Yeah, absolutely. Yeah. And before we get that CPI print, we actually get NFP on Friday, the payrolls report. Going to take a look at average hourly earnings. If we start to get into the 5s again on inflation, we're talking about negative real earnings growth once again. So not a situation that this consumer wants to get in.
All right, we continue to count you down to the closing bell. It's just about 20 minutes until we get there. Stocks holding on to their gains. But on an individual basis, some big flip-flops in the market. Keep an eye on Meta. Keep an eye on Constellation Energy. That's one of the big stories of the day. An eye-popping deal to buy nuclear energy. That's coming up next here on The Close on Bloomberg. All right, time now for our stock of the hour. Keeping an eye right now on shares of Meta and shares of Constellation Energy. A little bit earlier, we learned that Meta plans to buy a nuclear power plant in Illinois from Constellation Energy, a 20-year contract starting in 2027, underscoring the impact the AI is having on power demand. The co-host of this show is actually not here today. She's on assignment in Washington, D.C., and she joins us right now. Alix Steele, tell us what we know about this. I mean, this is a big deal, and we should point out we did see Constellation up almost 10% at one point on the day. Meta at one point was up 0.7%. How big of a deal is this?
It's a huge deal, and you asked me why the stock is down. So the best guess to that is the financials of this are really opaque. We don't really know what the terms are, but analysts are looking for it to be less expensive than the Microsoft deal. So the idea is with Microsoft and Constellation, that was at a higher premium than we're seeing Constellation and Meta. Now, there are reasons behind that. So for the Microsoft deal, they're restarting a nuclear plant. For the Meta deal, they're just continuing to operate an existing plant, so you don't need the same kind of premium, but maybe that was one reason. But it's so significant because if you want power today, you cannot wait for stuff like a hydrogen plant or like a new coal plant or a new nuclear facility, for example. You can maybe get wind or solar, but if those tax credits are going away, that's going to be a little bit dicey. So you know what's easy to get to? It's going to be nuclear and expanding existing nuclear energy. And that's why it's so key to see these deals come through.
Yeah, absolutely. We're talking about existing plants. You don't have to wait to build them. It is interesting to see the likes of Meta and Microsoft, as you mentioned, also signing a deal with Constellation back in September, turning to nuclear power. What's the appeal of nuclear versus other types of power?
Yeah, good question. So one, it's totally clean and it's not intermittent. So you can get solar and you can get wind, which would also be clean, but that's intermittent. So you have to supplement it with other energy like, say, natural gas. Nuclear, you don't have to do that. Also, remember that Constellation is sending that nuclear power to the grid, and then you have Meta pulling from the grid, and then there are the terms of agreement between the two. So there's more reliability when you put that on the grid. Doesn't mean you can't have wind or solar. It's not like you can't have a solar plant and behind-the-meter solar plant. It's just going to be intermittent, and that is where the risk lies. Also, building anything right now is going to be expensive. Just look at the tariffs that might come into effect tomorrow, right, on steel and aluminum. So it's going to be more expensive. If you have something that's already there, right, or even a coal plant, like not shutting it down, it's going to be economic in a different way.
All right, that is Alix Steele with the latest there. As you mentioned, Romaine, really wild to see this reversal in Constellation shares. I mean, we were talking about a double-digit % increase, now negative on the day.
I thought you were going to say the reversal between you being here and Alix being there. It's like kind of like a Freaky Friday. Who's the Lindsay Lohan and who's the
We'll discuss in the commercial, but after the break, we're going to talk to Tony Roth. That conversation up next.
Ten minutes until we get to the closing bell. Romaine Bostic here alongside Katie Greifeld. Stocks holding on to most of their gains here on the day. And coming into today, it looked like it was going to be a totally different type of price action.
Similar setup to what we saw yesterday, of course. Pre-market losses, and then we finish in the green. And unless something big happens in the next 10 minutes, it looks like we'll get a second straight day of gains for the S&P 500, up 0.5% right now. Those small caps leading the charge. I'll say it again, the Russell 2000 up 1.4%, breaking apart from the bond market.
Well, can we talk about that too, because we talk about the underperformance that we had seen from small caps and cyclicals.
Yeah,
this is like probably the most meaningful move we've seen, outperformance, I should say, we've seen with the Russell relative to the S&P since at least kind of think like the start of May.
Yeah.
So about a month we've kind of been in this somewhat drought, and that's supposed to be the thing. You have the equal weight S&P also outperforming on the day. That's supposed to be good, Katie.
Well, we'll see if this lasts, because there's been so many false dawns, so many stop and starts.
Glass half empty kind of person.
Well,
I thought I was supposed to be the pessimist on the show.
These small caps have burned me and burned me, so we'll see if this one sticks.
All right. Well, I mean, interesting that you use that phrase, because that really is now the parlor game going on. on Wall Street and, of course, in Washington. Joining us right now to help count us down to the closing bell is Tony Roth. He's the Chief Investment Officer with Wilmington Trust, and he joins us here in Studio 2 with just about 9 minutes until the closing bell. And I do kind of want to pick up on Katie's last kind of statement there about kind of being burned. It does seem like the last few weeks, you have a big sell-off, then people realize, oh my gosh, I need to get back in. You have this big rally, and then people get scared and they say, well, okay, what's enough? Where is psychology right now? Are people sort of finding some comfort in the chaos, or is it just still just kind of like, the squirrel in the middle of the street trying to figure out which side to go to?
Yeah, I definitely don't think anybody's finding comfort in the uncertainty. Yeah. You could say chaos. At the end of the day, we've got a big set of events coming up towards the end of the month. We have, of course, the expiration of the suspension of the tariff actions that the president has taken, so for both China and the reciprocal tariffs, assuming that they're still legal at the end of the month, which we think he'll find a way to make them seemingly legal. And then we have the resolution of, and I think probably a bigger issue, frankly, the resolution of the big, beautiful bill, and what level of increase in the debt load of the country will that take on? And so until that happens, we're in a period, we don't have earnings, and it's a fairly quiet period. And so a relatively small data point, like the labor information we got today from JOLTS, which suggests that the hard data coming at the end of the week is not going to deteriorate, can really move the market.
Well, I'm curious about that data because, that was data from April. So in theory, that kind of covered a lot of the chaos, the real chaos, kind of post-Liberation Day chaos. And if companies were comfortable hiring and putting out job openings, that seems to say that, at least in corporate America, and again, I know that's just one snapshot in time, that everything there is at least okay?
Well, I think going back, I think the economy is fundamentally in okay shape. There are no underlying fault lines or endogenous problems the way we had in the credit crisis or the pandemic having to put the economy into a coma, if you will. So there are no major fault lines there. The economy's fine. And we don't have an eye problem. We don't, namely inflation. I know that some of your prior guests sort of felt that the increases that might come with tariffs are tantamount to inflation, but we actually don't think we're going to get many more price increases net because there's going to be a drop in demand as the economy slows, and that will counteract effectively the tariffs. So when you wrap all that together, you have a situation where businesses are not going to cut right now because they're not seeing a big drop off in demand. They're not adding a lot to the jobs. So today's number was significant, not because it went up a tiny bit, but because it really didn't fall. And that's what made it important.
And since you mentioned inflation, I just want to make a clarification. We were interviewing Omair Sharif over at Inflation Insights earlier. He actually emailed us after he got off air just to clarify.
Did he?
He was not projecting that headline rate, that core headline rate to go from 2.8 to 5. What he was saying, I just want to quote him specifically, is that he sees the 1 month annualized rate this summer could touch 5%. So that means on that core basis, we're talking about you go on a monthly basis to 0.4 to 0.5. So just to be clear, to clarify.
And PCE, of course, just came out at 2.1, not on a monthly annualized, but on a year over year. And we don't really see pressure for it to move much higher than that over the next few months. Companies have a lot of room to absorb some of those tariffs in their profit margins, which are at record levels right now. So as that occurs, and you're actually seeing deflation in housing prices. Now, it takes a while for that to really make it through to the inflation data. But there's a lot of dynamics going on. And if you only focus on the tariffs, you can see price increases. But I think that 2.1% is going to hold throughout the summer and lead to Fed rate cuts as early as July, possibly.
Well, that would certainly be good news on the inflation front. But I want to talk about the labor market a little bit. Of course, we got the JOLTS data as discussed earlier today. We get non-farm payrolls on Friday, and you're starting to see some idiosyncratic headlines come through. You think about Microsoft, Disney out with some big eye-catching layoffs just in the past day or so. That's another situation where you have headlines, you have some stories, and you have sentiment not showing up in the hard data yet. So you think inflation will broadly remain under control, but how are you thinking about the labor market?
Well, we do think that as consumer starts to taper off, you're going to start to see companies cut back on the margin because they're going to have to cut their margins, and that's going to have to be essentially result in an effort to protect the bottom line, which means less people. So it may not show up. We're not expecting it to show up in this labor report, although I will say, as a footnote to the labor report for Friday, that this is a scenario where, in my view, bad news will be good news. And what I mean by that is we really need to have the financial markets exert some pressure on Washington. And while we're looking for the bond market to sort of call you know what, on the Senate, the stock market could do it too. And if we start to see some instability in the financial markets, whether it be the bond market or the stock market, it could put more pressure on the senators to take some of the criticism on the expansion of the deficit seriously. That would be good for investors over the long term.
Well, let's just talk about that a little bit more because I want to make sure I'm understanding you correctly. So I think about maybe the discipline that the bond market can enact. You think about when yields went crazy on the long end and went to the upside. It seemed to be sort of a braking mechanism there on Washington. Are you saying that, you know, the stock market needs to plunge here and maybe that would be the pressure exertion on Washington?
Well, I'm not saying it needs to, but I'm saying that the whole ecosystem is being driven by policy. And while we're focused right now on the formation of longer-term spending policy and taxing policy, in the immediate, it's tariff policy. And so if we were to see significant pressure in financial markets, which would be a tightening in the economy as a result of government action, that would help to wake up policy formation in Washington to the effects of their actions. So we're not saying that we want the stock market to plunge or that we expect it to plunge or even that we need it to plunge, because we expect the bond market to probably be, particularly the long end of the bond market, the 30-year, if it goes meaningfully above 5%, to be the main arbiter of what's going on in Washington. But in the absence of the bond market reacting, if the stock market were to react and start to really sell off, that could also be very helpful.
All right, Tony, got to leave it there. Tony Roth is the CIO over at Wilmington Trust, counting us down to the closing bells. Those bells now just about 2.5 minutes away, 0.6% gain. Katie Greifeld on the S&P 500.
Yeah, it looks like we're going to hold through the close. And of course, it's interesting to see big tech really leading when it comes to the S&P 500. NVIDIA helping out a lot here. And it seems like that leadership is back.
Also big gains on the day were from Dollar General as well as First Solar. Believe it or not, a full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to the closing bell with a global simulcast that starts right now. Carol Masser and Tim Senovic join us in the radio booth. Alex Steele and Scarlett Fu both on assignment for the day, and they are missing quite a day. 0.6% gain on the S&P 500, but a 1.6% gain, Carol Masser, on the Russell 2000. Outperformance by the small caps. Don't poo-poo it.
No, I'm not poo-pooing. It's your favorite index. I know you love those little critters. Having said that, I am looking at the semiconductor names because if you want to see some outperformance, check it out. The stocks, most of the names are higher today, and you're looking at the index up about 3%, almost 3%.
You know, I'm having trouble kind of making sense of the Look, the stock market is not the economy. We know that. The exuberance that we're seeing.
I disagree, but go ahead.
Excuse me?
I disagree, but go ahead.
You disagree? Okay.
Yeah, I do, strongly.
Okay, we don't have time to talk about that right now. We can talk about that maybe after the bells. But comments from the CEO of Dollar General earlier today about a weakening consumer, wealthier consumers trading down. That's why we're seeing shares of Dollar General higher today. How are we making sense of the sort of conflicting signals that we're getting about the health of the consumer and the U.S. economy?
It's interesting, right? I mean, we've had this conversation with Anthony Chukumba earlier that if you were looking for reasons to get worried about the economy, the fact that you do have the CEO saying that higher income consumers are coming to Dollar General, you could build a case to get a little bit bearish about the state of where we stand right now, Romaine.
All right. Well, I'm going to focus on one of the positives, and that is the outperformance that we're seeing in the small caps. And that is because of some of those names like those dollar stores. Signet Jewelers up about 13%, leading the charge in the Russell 2000. Fluor, Bloom Energy, Garden, and Credo also in the mix as well. So you're getting a bit of a broadening, at least for one day. And of course, you know, as a hat tip to Carol Masser, we've been here before, and we know this can reverse in a big way over time. Before we get to the closing bells, just a quick note here. Crossing the wire right now, a big headline on Wells Fargo. The Federal Reserve here in the United States has finally lifted the asset cap restriction on Wells Fargo. This, of course, has been in place for years, and we're seeing a big pop in the shares in the after hours, up by about 6%. We're going to get you some more details on that in just a second, but let's walk you through the broad market numbers with the Dow Jones Industrial Average up by 0.5 percentage point, the S&P up by 0.6 percentage point, the NASDAQ up by 0.8 percentage point, and the Russell 2000 up 1.6%.
Hey, I'm just going to piggyback on that. That cap on Wells Fargo has been in place for more than 7 years. We know that it went through a really tricky time with a lot of issues and a lot of different problems that caused that cap to be there. But Now you've got the removal of that cap, allowing the bank essentially to pursue growth again, closing the door on nearly a decade of scandals, and marks a major, major win for the company's CEO, Charlie Sharif. And as Romain said, we're seeing it pop certainly in the aftermarket.
And just real quick, I just want to stay on this for just one second. So the statement from Michael Barr, of course, the Fed governor who kind of oversees all of the banking supervision, saying that the removal of that asset cap does represent, quote, successful remediation to the required standard based on focused management leadership, strong board oversight, and strict supervision, holding the firm accountable. Of course, we've talked a lot with the CFO on this program. Every earnings season, we ask about this asset cap. This has been a huge constraint on the company's ability to grow. And of course, that means a constraint on the shares. That constraint, at least for right now, has been lifted.
Yeah, and you can see it with investors, right? Moving into it in a big way in the aftermarket. Right now, up about roughly 4% here, Katie.
Yeah, we'll continue to follow that story. Of course, like you said, Wells Fargo shares popping after market. But let's take a look at what did well today, because there's a lot to talk about here. If you take a look at the sector level, broadly an up day. Breadth was pretty good relative to yesterday, and you can see that it was tech that was in the lead here when it comes to what was gaining, what was losing when it comes to sectors. You also had energy higher as well. If you take a look at what didn't do too well, you could find something to peck at when it comes to communication services. That sector falling about 0.8%. Real estate, consumer staples also taking a little bit of a dive, but 8 out of 11 sectors in the green, Carol.
All right, guys, let's get to some of the individual gainers. As you said, Katie, a lot of winners in today's session. Hey, a lot of names in the nuclear energy space definitely gaining in today's session. Not everybody, though. If you take a look at Constellation Energy, we did see initially a pop, but it lost a lot of that, and I think all of it by the end of the close. Vistra, though, did hold on to most of its gain, up about 5%. That's a $59 billion power generation company that's up about 30% year to date. But again, the big reason we've been talking about this sector today has to do with Constellation Energy agreeing to sell a bunch of power from one of its operating nuclear power plants in Illinois to Meta Platforms. So again, we're thinking about AI demand, we're thinking about how we power it, and nuclear tends to increasingly be the way forward. I mentioned semiconductors. I think all 30 names in the stocks were up today, and that includes Broadcom, up about 2.9% here at the close. The company began shipping a new version of its data center switch chips that can boost the efficiency of AI accelerators, aiming to take a bigger role in the booming market for AI computing. So, yeah, all eyes on Broadcom. Keep in mind that it does report after market close. That happens on June 5th, so a little bit later this week. Dollar General, I think this is the number one gainer. Yep. In the S&P 500, finishing the day up more than 16%, its highest intraday ever as well. I should point out, we talked about this earlier, the company reported first quarter profit and sales that topped expectations, and management also boosted its comparable sales forecast for the full year, as well as the low end of its EPS target. And Tim, of course, gave some more color into Dollar General about kind of richer consumers, wealthier consumers, maybe trading down in this environment. So we wonder what that all means.
Have you ever been in a Dollar General, Carol?
I've been in some kind of dollar store at some point. Right. What are you saying? Nothing. Have you ever been in?
Of course not. You know I'm a snob.
I know.
Wow.
No, I can shop just about everywhere.
I'm gonna move on. I'm gonna move you guys on. How's that? I want to start with Kenvue. It was the worst performer in the S&P 500 on a percentage basis, down 6.2% today, falling the most intraday in more than a year. It comes after the company's CEO warned that seasonal demand is behind last year and behind Kenvue's own expectations. Here's what he said, quote, "It's not a great year so far for allergy, and the sun category is more or less the same." He said a longer winter season pushed spring later into the second quarter. It caused allergy products to see a later start to the season. He also said we definitely see that the consumer continues to be under pressure regardless of the geography for slightly different reasons.
Got to interrupt you, Tim. Sorry. Hewlett-Packard Enterprise is reporting earnings right now for their fiscal second quarter. The company says revenue coming in at about $7.63 billion. The street was looking for 7.46, so that is a beat on the top line. On the bottom line, adjusted EPS at 38 cents a share. The street was looking for 33 cents. That's also a beat. Here's your guidance. I'm going to start with the quarter. For the quarter, the third quarter, which is a quarter in right now. $8.2 to $8.5 billion is the range they're giving. The low end of that range is above the average of street estimates. On the bottom line for the quarter, 40 cents to 45 cents. The street on average was looking for 42 cents. And the company says that for the full year, it still sees free cash flow of about $1 billion. The street looking for $1.4 billion. So it looks like a beat on the top and the bottom line, and the guidance on both the top and the bottom line just around what the street was looking for.
All right, guys, let's get to CrowdStrike, man. This stock has been on a tear this year, up about 40% or so. The company out in terms of first quarter revenue matching estimates, but let's get to actually the outlook, because the company sees second quarter adjusted EPS from 82 to 84 cents a share. Street estimate is 82 cents a share. Also sees fiscal year adjusted EPS of $3.44 to $3.56 a share. Looks like it's upping it that estimate because it had seen $3.33 to $3.45. I'm looking at CrowdStrike, though down about 6% here in the aftermarket. So it looks like some investor disappointment. I'm just looking through first quarter revenue. That was $1.1 billion, the estimate. That was smack in line in terms of what the street was expecting. And first quarter adjusted EPS 73, and that was a beat of about 7 cents a share. So maybe some concern potentially about the outlook in the range, but we'll see.
I'm looking at shares of the enterprise software company Asana. They're shooting higher in the after hours, down from about 20% higher moments ago, up about 14% in the aftermarket. The company posted first quarter revenue that came in above the average analyst estimates at $187.3 million. First quarter adjusted at basic EPS coming in at 5 cents versus a loss per share of 6 cents. So obviously investors like to see that. Shares jumping in the after hours right now, higher by about 14%.
I want to go back to CrowdStrike because you're seeing losses deepen in the post-market right now. CrowdStrike shares currently down almost 6% right now. And Carol, you had mentioned it that this stock has been on a tear. Expectations were certainly high with the stock up 43% year to date. But it's that outlook that didn't quite exceed expectations. Second quarter adjusted EPS, just to reiterate, seen at 82 cents to 84 cents. The estimate had been for 82 cents. So you think with the stakes that high, maybe a little bit of disappointment, and that's certainly what you're seeing in the shares right now, Carol.
Right. You also do have CrowdStrike reporting a share buyback authorization of up to $1 billion, but that's not certainly getting investors excited. Again, the stock down 6.3% in the aftermarket. All right, folks, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, Katie and Romaine continuing on TV. Tim and I are going to hit the road, so you guys are going to have surprise anchors tomorrow. Anyway, we will see you soon. All right. That's a wrap. We'll see you again, same time, same place tomorrow. Some of us.
And our coverage continues here on Bloomberg Television with a closer look at some of the big movers in the after-hours trade. That includes HPE, and that includes CrowdStrike. CrowdStrike down about 7% right now. A conversation with Jessica Inskip, Director of Investor Research at stockbrokers.com. That's coming up next here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. A relatively good day on Wall Street with the S&P adding about 0.6% on the day, but it's really the second line of your screen there. The first meaningful outperformance by the Russell 2000 in 5 sessions, and the widest outperformance relative to the S&P going back to early May. You did see minor activity in the yield space, though. As you can see on your screen, yields, at least on that 10-year benchmark, relatively unchanged, and Bitcoin getting its mojo back up about 1% to 106.
Let's take a look under the hood and see some of the biggest movers on the equity side. I wanted to highlight NVIDIA. No specific news, but adding another 3%. This stock has added about $1 trillion back in market cap over the past 2 months, really helping to support this market. You also have Hims and Hers up there. This is an interesting one because at one point was up as much as 19% after news broke that Hims and Hers Health is buying telehealth firm Zava in an all-cash deal to expand its footprint in Europe, but those gains reversing and then some And then CoreWeave, a recent IPO, and its hot hand continues, adding another 25% today. That's after news that it's entering into 2 lease agreements with Applied Digital. It's going to provide for them, and that was good for a 25% gain in shares of CoreWeave, Romaine.
All right, those were the movers, of course, in the cash session. We're going to spend the next half hour or so really talking about some of the post-market movers, and that includes Wells Fargo. The shares right now up about 200%. This just after the Federal Reserve agreed to release Wells Fargo from that asset cap that had restricted its balance sheet size for the past 7 years. That means, well, that the bank has finally completed all of the required conditions that the Fed had set in place, and a big question about what comes next. Sally Bakewell, who helps to lead our financial coverage here at Bloomberg, joins us right now here in Studio 2. All right, let's start off. This was imposed all the way back when Janet Yellen was still the Fed chair, if I believe, right? That's correct?
Correct.
7 years. The idea that this asset cap basically meant your balance sheet can't go above this amount, which basically means you effectively can't, if you're a bank, you basically can't grow.
That's right.
Yeah.
This cap effectively restricted Wells Fargo's growth at the level it was at in 2017, which was with assets of about 1.95 trillion. And it hasn't really been able to grow like its rivals since then. And to put that in a little bit of context, JP Morgan has almost grown in terms of asset size another Wells Fargo in the time that it has had this cap. So this news is really a huge deal for the bank's CEO, Charlie Scharf. It's the end of an era of nearly 10 years of it trying to escape these scandals that emerged around 2016 and related to sort of mis-selling and of certain products and opening of accounts. So this really is now the moment that they can really focus on growing in terms of their investment banking and catching up with their Wall Street rivals like JP Morgan and Bank of America and Goldman Sachs.
And maybe there's a catch-up coming in the shares, too, because you take a look over the past 7 years, Wells Fargo's up 68% over that time, which isn't bad, but then you compare that to JP Morgan and Goldman Sachs, both up 200% or so, or in that ballpark. So let's talk about the future. Charlie Scharf has to be feeling pretty good right now, and now that we have this cap lifted, what would you imagine is close to the top of his to-do list?
Well, I think that he had already put a lot of focus on expanding its sort of Wall Street engine, boosting trading, boosting investment banking. So without the cap now, he can really sort of go full throttle into that. And the bank now is a much more appealing place to work for those for traders, for investment bankers, because they know that they can probably take a little bit more risk. They know that they can really grow. So really now I think this is Charlie Scharf being able to play on the offense. I mean, it had really impacted the bank's strategy and the bank's growth over these years in many ways. Charlie Scharf, he shed a number of businesses that they didn't see as core. He also restricted and cut certain headcount growth. So the bank has been really dedicated to ending this restriction.
And it's interesting. I mean, Bloomberg reporters basically did some calculations and found that maybe we're talking about something like $39 billion in profits were effectively left on the table going back to 2018, largely because of that restriction as well as other restrictions that they've now gotten out from under. I guess the question for you, Sally, is kind of what comes next, right? Because like, what is the identity of Wells Fargo? I mean, we tend to look at it primarily as a consumer-facing bank, personal loans, consumer loans, auto financing, things like that. In a few years, if we're still talking about them, are we going to be talking about them more as a trading house, as an investment bank, or are they still going to be that consumer-facing loan business?
I think it's both. I think they still very much want to be consumer-facing, and they have made certain specific pushes in some markets. In New York, they are opening a number of new branches, but in a way, that's also with the aim of being more present on Wall Street. So I think the future for them is to be this much bigger presence among its Wall Street rivals.
More branches. Yeah, that's what the city needs. Yeah, we got like 3 new branches of banks just right across the street here.
Yes,
There's Citibank, Capital One, something else. I forget.
Capital One has a cafe.
They have a cafe. Yeah, so there's that. You can take out a loan and get yourself a cup of coffee. Sally Bakewell helps lead our financial coverage here at Bloomberg. Our thanks to her there. Of course, big news for Wells Fargo. Those shares had been up as much as 6% in the after-hours trade. Now up about 2.5%. We're also keeping an eye on shares of CrowdStrike and keeping an eye on shares of HPE, both moving in opposite direction on the heels of their latest earnings results. Jessica Inskip joins us right now, Director of Investor Research at stockbrokers.com. Jessica, great to see you again. I want to start with CrowdStrike because that is the more dramatic mover on the day. And at least for me, a bit of a surprise. I kind of thought CrowdStrike was kind of getting its mojo back after all those issues that it had been dealing with, from a year or two ago. What did you make of the results that we got today?
Yeah, I mean, I'm definitely looking to see if there is any margin compression there. There was also a recent acquisition that we need to dig through. But what I want to see from CrowdStrike is giving me an indication into demand for the broader AI thesis overall. I still think it's absolutely a need. We have a need for a lot of infrastructure and even security associated with that. So still need to dig through the details, but it's just interesting to see how that'll play out.
Well, when you talk about sort of that, I guess, more structural trade when it comes to cybersecurity and AI, and I do wonder where CrowdStrike fits into that, because this is a pretty competitive space. I mean, it's, they're not sort of the standalone. But do you think that they have established themselves as kind of a go-to to a certain extent in that space?
I don't think they're first that come to mind, and it's the go-to necessarily for investors or that translating over even into earnings. But there is still proof there. There's still large demand for that. So whether they've established themselves or not, I don't think would necessarily be the issue. Again, that forward-looking guidance as well is important to dig through.
Let's talk about cybersecurity as a theme, because AI obviously is one of the big long-term themes that investors seem to want to put their money behind right now. When it comes to cybersecurity, I mean, we're about to talk about Victoria's Secret in a couple minutes. You have to imagine that cybersecurity is up there as well. Where do you put that when you take a look at thematic investable themes right now?
So I think with this type of government or administration that we have, it's taking a little bit of a backseat, and it will need a front seat going forward because of the importance that's there, especially if we look for broader AI adoption for very data sensitive places like banks. That's going to be very important for different cohorts within the market. Now, because the way that you have to, from an enterprise level, to bring AI, you need to go to the cloud, which means you need to have data stored there. To have that cloud infrastructure, it requires a lot of security. And so it's really on the enterprise level. But if there is no regulation requirements, it may take a backseat. And that could be a concern. And we see that with some deregulation that's coming in with AI, even some that are looking through right now, or that 10-year on the state level. That's important to pay attention to and may require it to have a backseat, but it really shouldn't because of the cloud infrastructure component of artificial intelligence.
It'll be fascinating to see how that narrative develops. But let's turn our attention also to HPE. Hewlett-Packard Enterprises also reporting quarterly revenue. It topped estimates, actually. But part of the reason why the shares might be gaining after hours is because the company said it expects a reduced impact from tariffs on its business this year. It seems, Jessica, that across industries, that's increasingly getting rewarded, a company's ability to basically navigate whatever is going on the trade front.
Yeah, absolutely. If we're taking the word uncertainty that's been thrown around earnings calls, and that uncertainty relates to tariffs, if we can put certainty around what we don't know with tariffs, which we don't understand the impact overall. We don't understand how it's going to translate into inflation. So I think from an earnings call perspective, that is an incredibly smart move that will be rewarded, because we want clarity around tariffs very specifically. And I think it's very difficult for the market to go higher until we have more of that.
Well, yeah, well, certainly so. And I mean, it doesn't look like they were going to get that, though, Jessica. And I do wonder if the market can become comfortable with it. We talk about sort of these large structural trades, and obviously AI is that. And I know it's not immune to what's going on with tariffs and trade and what's going on in Washington, but the general idea is that it can kind of supersede that over the long term. So when you start to look at who the winners and losers are going to be, which companies are going to benefit from it most. I mean, we look at a CrowdStrike, we look at a HPE, but that's not where investors' attention has been at, right? It's been at NVIDIA. It's been at, maybe to a certain extent, like on a day like today, with some of the energy companies that are going to power these data centers here. Where do you see that trade going next?
Yeah, so I do believe it started with the chips and NVIDIA semiconductors, moved over to uranium now with this need for nuclear energy. But I do think there's a benefactor that's coming to play that we haven't talked about too much, which is tokenization, stabilization, stable coins, and even the blockchain. And that has to do really with where I'm seeing fiscal spending, what I'm seeing from our administration. There's evidence from the DJT investments, the meme coins that are there. JP Morgan and Bank of America are possibly moving forward with their own stable coins. The crypto platform Kraken just announced tokenized equities, which is very interesting. There's some from BNY, even JP Morgan, and all of that's required for tokenization and getting on blockchain. There's still there's still a need for data center and infrastructure. And that's a very important component when we think about the next leg of the AI rally. When I listened to the conference call and from NVIDIA earnings, and I hear Jensen Huang speak about the AI data center demand, that data center demand is not just from AI as well. And as we have more fiscal implications, more bills, or even a Fed Now coin come into play, that could be a catalyst that could absolutely be another leg higher within the same securities. It's so interesting. The same securities that benefit from AI are the same securities that would benefit from tokenization, stable coins, and alike.
All right, Jessica, great to get some time with you. Appreciate your reaction to these earnings reports. That is Jessica Inskip. She is Director of Investor Research over at stockbrokers.com. And speaking of cybersecurity, Victoria's Secret plunging, or rather falling today, now up a little bit in the after hours trade. That's after the retailer postponed its first quarter earnings report, citing a recent security breach. Now, that incident really overshadowing better than expected preliminary results and threatening to hit second quarter sales. For more, let's bring in Mary Ross Gilbert. She is Senior Equity Research Analyst over at Bloomberg Intelligence. Mary, it's great to have you with us. When you think about this specific incident, this specific breach, and you read about the details here, what we've heard from the company, how confident are you is that this is a one-off event versus something that we might see repeated?
Well, Katie, it's a really good question. It happened with Marks and Spencer's, and the hit there was much larger. They still haven't gotten their online site back up, and that was like a 300 million pound hit to their profitability is what they've disclosed so far. For Victoria's Secret, they were out about 4 days. And when we look at consumer transaction data, so that's Bloomberg's second measure, and we're looking at the web traffic there, you'll see that sales bounced back right away. So when we look at that, we're actually seeing sales really back on trend again. And so this could be just a short blip in terms of sales. Now, operationally, they're still dealing with some of their, back office or some of the operations there that are still not back up fully. We don't know the details around it. But maybe in the next week or two, once they're able to get all of this sort of resolved, we'll learn more when they go to report earnings that were originally scheduled to come out on Thursday, June 5th, before the open.
Well, that's what I'm curious about, Mary, because, this incident, or at least the revelation of this incident, comes at a time where the company really is trying to, I don't want to use the word restructure, but certainly, I guess, refine its footing, if you will. And it gets to this idea as to how much of a handle management has on things right now, and if this even if it's not a material to the bottom line, whether it is going to be material to the rebound that they've been trying to create for this company.
Yeah, so Romaine, actually, Victoria's Secret their business has really stabilized, or their market share, I should say, in the U.S. has stabilized, and they're growing at a pretty fast pace overseas. It's a much smaller piece of the business. So actually, they're in a really good position in terms of the turnaround, and we are really expecting to see it inflect. But of course, you sort of brought up some important points, and that is they have a new management team, and that's headed by Hillary Super. She was formerly with Savage ex-Fenty, and she's also brought on some other executives that came on within the last couple of months. But the systems investments, they put in a new ERP system under the prior management team, stabilized the operations. And like I said, market share, they've been picking up share over the last couple of years. So I think we are certainly seeing better traction. If you look at the product is fantastic, and they're really winning with the young consumers, with Gen Z and millennials. So I think that they are in a good position, but there's also some other interesting dynamics going on, because they just they just adopted a poison pill, and that's going to be good for a year. And that's because you have this Australian billionaire, Brent Blundy, who's had 2 successful lingerie branded businesses that he's, started and sold off. And he's already started a new one. And of course, he's built a 13% stake here. But of course, this poison pill won't let him get, above 15% unless they come to some sort of an agreement and negotiate on a transaction at a favorable price for the shareholders.
All right, Mary, got to leave it there. Mary Ross Gilbert, of course, covers this company for us. A closer look there at the moves that we saw. Of course, those shares ended the day down by about 2.7% to be precise here. But of course, we are still waiting to see when they are going to actually release the full earnings. As they said in their most recent release here, this won't be material to the past quarter.
Right.
It'll be interesting to see what happens going forward. And we are going to focus a little bit more on the retail space coming up. We're going to talk to somebody who deals with a lot of like the whole, the TJ Maxx's of the world. But we're also going to talk to somebody, I don't know if you have her shoes, Sophia Webster. And I have one big question. Why doesn't she make men's shoes? I like these shoes, the women's shoes she makes. I can't wear them, obviously, but
you can.
I like her style.
If you tried hard enough.
Yes, I guess anything goes in this day and age.
This is Bloomberg. While the luxury goods market remains in focus as consumers feel the pressure from tariffs and from inflation, someone with a unique perspective on this is Sophia Webster, a luxury shoe designer of her namesake brand. Her footwear and accessories have appeared in the show just like that. And names such as celebrities Kim Kardashian and Jennifer Lopez are among their clients. I'm pleased to say that Sophia Webster joins us on set now. She also just released her first book. Oh my gosh, I love your shoes, to mark the 10-year anniversary of her brand. Sophia, great to see you.
Thank you so much for having me. I'm really happy to be here.
So we have a lot to talk about here, but I do want to start with the consumer. As I mentioned, I mean, that is squarely the focus of a lot of investors right now because it's rough out there. I mean, even though we have inflation leveling off in terms of rate of change, we know that prices are much higher than they were a couple years ago, and there's a lot of fears about what the next several months could hold. From where you're sitting, how is your consumer feeling right now?
Well, I can only speak for my brand. So as a British brand, I think that we the tariffs for us were pretty favourable. So we haven't really seen a huge effect from the tariffs because we produce in Spain, in Italy, in Portugal and Brazil. There's only really one item that I produce, which is a Minaudier box clutch that's produced in China. So we don't have that on our US website. But really, we haven't really seen that much of an effect. But I would think with it's caused a lot of confusion. So definitely the consumer confidence might affect us. It's hard to tell at the moment.
Yeah, well, that's where I'm really interested. It's really fascinating to hear that, given where you do your production, you haven't really felt an impact necessarily when it comes to sort of your supply chain, that side of the business. But I mean, you look around the world right now and there are fears that we could see people start to pull back. But it sounds like what you're saying is you haven't seen that sort of behavior yet.
No, we haven't yet. And our customer is very loyal as well, so she always comes back, knows that they're going to get a product that has been designed with love. There's a lot of attention to detail, there's great craftsmanship there. So I think, brand loyalty right now is going to be key.
I'm curious if that even works even more so for you, because, I mean, this goes beyond just the quality of the shoe. I mean, obviously you have a very unique style, a very unique aesthetic. Yeah. And, there's this idea that even when you have hard economic times, people will indulge in certain luxuries to make themselves feel better. And I would think, something like a nice... Speaking of yourself, I love shoes. By the way, we can get to the reason why you don't make men's shoes in a second. But I do wonder if that sort of insulates you from that. And you built this brand really organically. I mean, you really were from the bottom up, very digital forward, social media forward in a way that I think traditional manufacturers, traditional retailers aren't. And I do wonder if that helps you in this type of environment.
Yeah, definitely. I think we've always gone against the grain. We haven't done things just because that's the way they've always been done. We've made decisions that we feel work for us as a brand, and also we really celebrate our customer, and we have that communication with them, that direct communication. We've always had that, and we love using their user-generated content. We show the customer off on our feed, and I think a lot of luxury brands don't operate like that. They're a lot more curated, let's say, and they don't necessarily have that same connection.
There's definitely an organic nature to it. I mean, we mentioned, of course, in the intro, your shoes are appearing in the new Sex and the City series, and they've appeared in other series. I mean, how does that come up? Because that's not necessarily organic. I assume your marketing folks have to talk to these folks and say, look, it'd be great to get it. Or maybe I don't know, maybe it's just Sarah Jessica Parker or somebody just decided we're going to wear these shoes.
Well, for many years now, we have designed shoes with the red carpet in mind, or for celebrity wears. When I first started my very first collection, I wanted to come out with a bang and get everyone's attention. So the shoes were very colourful, they were very playful, there was lots of details on them, beads, tassels. I was just like throwing everything at it. And I soon realised that actresses, on the red carpet in Hollywood, they wasn't really appropriate for that. So then I went and spoke to a Hollywood PR agent, Heather Madison. She was really pivotal, I would say, in getting our shoes on the red carpet. And I asked her, like, what do I need to get the celebrities to wear my shoes? And she was like, you need metallics, you need satins, things that sparkle on the red carpet, things that act like a true accessory. So for me, it was very strategic to open that category up.
I saw some story. Is this true about Rihanna? How you had given her a pair of the shoes and she just had them in her closet for years, and then one day at some red carpet event she wore them, and of course the world went insane because Rihanna was wearing your shoes.
That's true. That's one of the reasons why I actually wrote my book. Why that started was because it was about 5 years later, in the middle. I think we just got out of lockdown in the pandemic, something like that, and she came out with a whole, it was like an optical illusion outfit, and the shoes were inspired by that as well, black and white checked, and I was like, wait, that's those shoes, and I gave them to her 5 years earlier. So it was for me, that was just like, wow, because imagine the amount of shoes that Rihanna must get gifted in her orbit, the amount of fashion that must come and go, and the fact that she held on to those shoes because they were really special to her. That was, that's amazing.
Say, can you imagine how big her closet must be?
No,
if, she just had these shoes, hadn't seen them for 5 years, and found them one day. We don't have much time left, but I do want to ask this on behalf of Romaine. Would you ever get into men's shoes?
I have actually. I did a loafer capsule collection once before, so I have done that. Yeah, I mean, I would love to do that. I'm definitely looking to open up new categories. I've got jewelry coming later this year.
You're doing bags?
So I already do bags. I do mini. I have a kids collection, but men's. Maybe.
All right. Well, your success has been phenomenal. It's been great to watch over the last 11, 12 years, however long it's been. Sophia Webster, of course, who runs, of course, her namesake shoe design, a brand. We do want to say, and by the way, we don't get gifted shoes. We're not like Rihanna, or anything like that.
Exactly. So, we don't have a closet full of shoes.
But we do want to stay on what's been going on in retail space, and specifically with consumer spending, with some big earnings this week, PVH among them, as well as Lululemon. We want to bring Lorraine Hutchinson into the conversation. She's a retail analyst over at Bank of America. She joins us here in our Bloomberg studios. Great to see you, Lorraine.
Thanks for having me.
Look, we're going to go from a hard pivot from, really fancy shoes, so I guess more pedestrian fare, but it's still important. And I mean, you cover a lot of the big retailers, and we've heard from some of them already. We're going to hear from a couple of more apparel makers, including PVH, and then I think Lululemon on Thursday. Let's start with Lululemon, because this was kind of the brand that really came up organically, really established itself as something unique and different. Of course, everybody's doing athleisure now, and I do wonder where they stand out and what your expectations are when we see their earnings report.
Sure. I think, that all eyes are pointed on the U.S. comp. Mm-hmm. The same-store sales growth in the U.S. has been a real controversy for Lulu because it fell off last year. I think what happened is they focused too much on their core, and they really didn't have the newness or excitement that the customer was after. So she went somewhere else. Now they're really re-engaging with a huge platform of new products. We've started to see that come through in the first quarter. And I think the direction of that North America same-store sales growth will be the single biggest driver of the stock on Thursday night.
But how are they doing in terms of, I just mean in terms of the marketing? Because I think about when Lululemon, at least when it first came to my attention, it was like there were so many things going on in their stores, right? You would go in there and take yoga classes and things. They had, a certain ethos, if you will, whether you agreed with it or not, that's a whole other conversation. But they had a real identity. Yes. And I do wonder if they still have that. I know the founder has moved on for a variety of reasons, but the ethos of this company and what it's trying to be, is it still there?
It is still there. Yeah. And, some of that was put on hold during COVID, of course, because you can't do in-store. But they're back doing the in-store. And I think what's interesting, too, is as they're expanding internationally, they're building that grassroots sense of brand and marketing. I visited their China operations in October, and it was really interesting to see the local marketing, the local events, these huge activations they were planning in cities like Shanghai. So they really are taking that playbook and expanding globally with it.
I do want to go back to Gap earnings, because as we look ahead to Lululemon, Gap owns Athleta, and it seems like that was a disappointing part of their report. Athleta, of course, also is huge in the athleisure space. So, when you take a look at those figures, does that give you any pause as you look ahead to Lululemon?
Athleta's been struggling for a while, and they've really don't have the product right to target their existing customer. They were bringing in some new customers with new product, and I think they really just missed the mark a bit on their existing customer. So they ended up having to mark down a lot of product. So that was a disappointing part of the Gap's story on Thursday. I don't think it has a lot of play over to Lulu, because I think Lulu's in a very different point where they've launched the newness already that will get their existing and new customer excited, and we think it's starting to show.
Yeah, I have to say, I live in athleisure, so...
She's not lying.
That's true. I'm either in this or I'm in leggings. In any case, I do want to talk about pricing strategies right now. We've been talking about Walmart all show. We've been talking about Dollar General, also warning that price increases could be in the offing, and seems like a great excuse. For right now, in this moment, you're looking ahead to tariffs. You could raise prices, and you have a good reason to do so. Do you think that we're going to see more of that?
I think they'll try. I think they have to try, because their costs are going up. My companies mostly import from Vietnam, a little bit of China, mostly other Southeast Asian countries, but either way, their costs are going up. I think the nuance here is what I cover, apparel and footwear, is all discretionary. You don't actually have to buy any of it. So I always think the consumer sets the price. And I know that sounds a little bit backwards, but it's true. If you see something that you don't think is a good value, you just don't buy it.
Yeah.
You're not sitting there looking at it and saying, I have to have it. I have to have it. So you just don't buy it. And you wait and you say, maybe that'll go on sale.
Yeah.
And chances are, if it's not the right value, it will. And so the out-the-door price was determined by you, the consumer.
I never heard that, but that actually makes sense. I definitely do that. I just bookmark it and hope that it goes down to 40% off. Lorraine, really appreciate you taking time for us. This was a real treat.
Thanks for having me.
Lorraine Hutchinson, retail analyst over at Bank of America. A closer look, of course, at some of those earnings that we're going to get later this week. PVH tomorrow, I believe. Lululemon on Thursday, and we mentioned Gap and a few others that we already got.
Yeah, looking forward to those. I have to say, you look over the whole of earnings season, because we're really in the last dregs here. Not as bad as expected. You did see some companies pull their guidance, of course, but certainly not the sort of catastrophe that some were projecting heading into this earnings season.
And that's a big part of the reason why I think you saw some of the strength in the broader markets today. We take a look at how markets close, a 0.6% gain on the S&P, but outperformance when it comes to cyclicals, when it comes to small caps. The S&P equal weight outperforming the S&P 500, and so too did the Russell 2000. We'll be back in a moment. This is The Close on Bloomberg.
Well, dollar stores are saying that they can buck the tariffs, but the big box basket is quietly bracing for impact. Walmart jacking up its prices, according to the New York Post, and others, including Target, are saying... They're reputable. In any case, Target also saying they're, quote, adjusting prices to mitigate potential pressures. United National Consumer Suppliers is one of the largest wholesale distributors for Macy's, BJ's, TJX, and a whole host of other big box stores. And we've got the founder and CEO, Brett Rose, with us live. Brett, great to have you with us. And this really is one of the big themes out there right now, one of the biggest storylines, that prices that are being passed on to consumers are going to rise from here. You sit at a different point in the supply chain. Is that broadly your expectation as well?
Yeah, it's interesting, Katie. I didn't expect to post article this morning, but how Walmart is slowly creeping their prices up. And we've been watching them very closely. But when you have so much stuff coming out of Southeast Asia, it's inevitable that at some point, either the retailer is going to absorb the hit, the consumer is going to absorb the hit, or the market's going to snap. And, we're seeing pricing. It took longer than we anticipated, but it is creeping up.
And how are some of the companies that you work with approaching inventory right now? Because that was one of the big stories over the past couple months, especially with autos. You had consumers pulling forward their purchasing. Are you seeing some of your customers stockpile here?
Yeah, consumer retailing is almost a different animal than some of the other larger purchases like automobiles. Discount retailers are positioned really well to ride this out. When you look at a retailer like a Walmart or a Macy's or a traditional big box retailer, Lowe's, Home Depot, we just had Macy's restate their anticipated income for the year. They're certainly going to feel the whiplash because they can't move fast enough to sort of outrun the tariffs, right? Every day, this is a changing market. U.S. consumers are confused, which leads retailers to, their supply chain it's supply chain confusion. We almost don't know what's coming next, Katie. We have to be able to turn on a dime, very similar to March 2020.
I am curious, Brett. I mean, your business, you kind of, I guess to a certain extent are kind of a matchmaker, if you will. You help to get a lot of these products, at least the discounted products, to stores like TJ Maxx, which we just had on the screen there. And I am curious as to how this on again, off again, high again, low again tariff environment affects that or disrupts that, if at all.
We're seeing amplified inflationary tactics remain at the register. People are trying to hedge their bets. So what we're seeing is a ton of panic buying. So walking to TJ Maxx, when she walks into TJ Maxx, she buys something that she sort of browse and buys, right? She doesn't necessarily go in with a specific item in mind. She walks up the aisles and she hedges. So she sees something that might be better priced than normal. She's going to buy more. Look at Dollar General. When you have a stock that's up 20% over the last 3 months in a volatile retail environment, this particular case, the tariff is helping them because it's fear, right? The consumers are so fearful they're buying more. They're not panic buying like they did in 2020 of toilet paper. They're panic buying everything like they did in 2020, right? It's bulk buying at its finest for me.
All right. Yeah, I chuckle because I've got a closet full of toilet paper and paper towels that my wife doesn't know about yet. But Brett, in all seriousness, we get to this idea of that, not just the health of the consumer, but this idea of, there's sort of necessity and then there's discretionary, but there is kind of this gray area as well. And you seem to be kind of hitting on that with this kind of browse and buy thing as well. There are things that we don't always necessarily need, but if we can find the right price or we stumble across it at the right price, then fine, we'll whip out the credit card and bring it home. Is that going to be enough, though, to support the industry writ large, or is it just going to be a few players that end up benefiting?
So we're definitely going to see the larger retailers benefit, Romaine. I think, unfortunately, the one thing the tariff is going to do is it's going to drive the nail in the coffin of a lot of small businesses that can't necessarily absorb the hit. But, take what you just said and sort of amplify it a little bit. Maybe you don't need to buy it. Maybe you're thinking about it. Maybe you have the room on your credit card. However, now throw in the fact that maybe it's not going to be the same price in 2 weeks because a tariff may go from 34% to 65% or 65% to 100%. That's fueled by confusion. I would venture to say the average U.S. consumer doesn't fully understand the tariffs. You and I live it every day, right? And for the most part, I couldn't fully explain it to you. So I think what's going to happen is she's going to go in, she's going to see a deal on toilet paper or napkins. And by the way, I have a feeling your wife after the show is probably going to know that you've got a bunch stockpiled at home, right? But all of a sudden, she's going to go in and she's going to buy it because she doesn't know if next week it's going to be priced really high. In 2020, we saw that because she didn't know if next week it was going to be there. So same result, different driving factor.
I'm sure your wife watches every single show with the sound on specifically. So
only when I'm speaking.
That's true. That's true. It's on mute right now. But Brett, I am curious. I mean, you think about other points in time. I've heard a lot of people compare this moment, particularly in the markets, but also in the economy, to maybe some parallels to the 2020 COVID crisis, for example, and other parallels like that. When you think about, your history with this company, I believe you founded it in 2002. Do you have any blueprint that you can turn to in terms of, how consumers and how some of these big box retailers are navigating this moment?
I think everything we knew we threw out the window in March of 2020. Then we threw out the window again in March of 2021 when we had whiplash. Wall Street did the same thing, because if you remember, one of the things we looked at very closely in 2021 and 2022 was stock prices tanked when inventory levels got high. So now it's this, what do we do, Katie? Do we stock up knowing the prices are going to get high? By the way, then if the tariffs go away, now a retailer is sitting with heavy inventory levels and the street's going to kill their stock price, right? So what we knew 2 years ago, 4 years ago, 6 years ago is very different than what we knew when we started this business in 2002. It was always sort of looking for the next deal. We never really took into massive consideration supply chain. And by the way, the round peg, round hole supply chain concepts we all knew, again, fell out the window. Because think about this, when the tariffs go away, we're going to have a tail of issues that are coming behind this. There are lots of ships arriving in Long Beach empty. There are tens of thousands of containers sitting in Southeast Asia right now waiting to be loaded. And when all of a sudden those ships get loaded, now you've got a backlog at Long Beach and some of the other ports. So it's going to lead to further issues. So this is a problem, regardless of what happens with tariffs, that's here for the next 8 to 12 months in one form or another.
All right, Brett, got to leave it there. Great conversation. Brett Rose, founder, CEO of United National Consumer Suppliers. And we should just point out, for our viewers, we do get a slew of retail earnings over the next couple of days. Tomorrow morning, you're going to get Dollar Tree. You're also going to get PVH Five Below. You know what I love about Five Below?
It's below $5.
No, they have the biggest assortment of Haribo gummy bears of any place I've ever seen.
I've heard that you do like gummy bears.
All right, we're going to talk about that and some of the other things that could potentially move the market. That's coming up after the break. This is Bloomberg. All right, let's set you up for what to watch over the next 24 hours. Some of the things that could potentially move the market. King Katie, we start off with earnings before the bell.
Absolutely. We have Dollar Tree. Of course, we had Dollar General earlier today. We also have Five Below aftermarket. So a lot of these discount retailers. We also have the likes of MongoDB reporting.
Absolutely. Here, ChargePoint, PVH also scheduled to report at 9:45 a.m. in the morning, though we are going to get some other economic data. Those S&P Global Composite PMIs.
And then 15 minutes later, we have the services index coming out. This is a market that really wants to see economic data, but it all feels like a preview before NFP on Friday.
I am curious, though, about this. I mean, we got the ISM manufacturing data, of course, a much smaller part of the economy. That was not good. The big question is, how is the services side of the economy holding up? But remember, we did see a few cracks there in the last couple of reports. And it'll be interesting to see whether there's any feed through when it comes to the Fed, because we are going to get your favorite release from the Fed tomorrow at 2 p.m.
Yeah, some anecdotal data coming up in the Beige Book. That comes out at 2 p.m. It'll be interesting to hear from the different regions in this country, as anecdotal as it is.
You sound really excited for that. All right, thanks to Katie Greifeld. You can catch her every day on Open Interest. I'll be back tomorrow here on The Close. Balance of Power is up next.